I'm Dave Brinkman, partner in our wealth management group, and again I'm joined by our Chief Investment Officer, Jason Staley. Jason, you put together our second quarter letter. There is a ton to unpack. Markets are moving. We're sitting here on July 13th. This will come out next week. The inflation number just came out today, highest number since November of 1981. There is a lot to unpack this quarter. Would you like to maybe articulate maybe the opening and maybe some thoughts as we get into capital markets?
Yeah, I think that when you go through a quarter where you're off to the worst start in the S&P 500 since 1970, as you just said, we closed June with the highest inflation print since 1981. And according to Deutsche Bank, we're in the worst bond market since 1788.
We'll take their word for it.
Full disclosure, didn't run that by anything in compliance. We kind of figured if they were going to throw that out there in a paper that Deutsche Bank will give you that. But I think when you think about the worst bond market that anybody that's investing has ever seen, the worst start to the S&P 500 for the first 6 months since 1970, and then you get this inflation print that just came out this morning, where you're taking back to 1981 to get an inflation print that's high. I think that you have to take a step back and acknowledge that there's been a lot of pain in capital markets, and one of the things that we try to establish in this letter is that we have gone through a market where your traditional safe haven asset, U.S. Treasury bonds or high quality municipal bonds. In the case of U.S. Treasuries, you're down something like 11 or 12%. High quality munis, you're down kind of 9.
Yep.
Those are supposed to be the ballast of your portfolio, and we are among those that say that. But when you have inflation running as high as it's been, and you are raising interest rates as quickly as the Fed has, that's going to have an effect on the ballast of your portfolio. And you've seen spillover effect and into the stock market, where I think the best performing asset class is kind of down 20%. For the
EM down 18.
EM down 18, Alex, for 500. And so I think that you look at that, and there's just not been a whole lot of places to hide. And we're going to talk about some areas of the market where we've been able to generate some attractive returns, positive total rates of return for our clients. But our portfolios weren't immune from the volatility and the drawdown in capital markets, and we wanted to be really upfront and honest with that, and that's kind of what we tried to establish in the beginning part of the letter.
So let me backfill on some of the numbers you highlighted, and then we'll kind of get into it and go where we want to go. So in meeting with clients here over the last couple months, let's start with interest rates. You've seen the 10-year Treasury growth basically double in 6 months. Went from 1.5 the end of last year to more or less 3%. It might have peaked at 3.5 maybe in June, and it's dialed it back a little bit. The inflation number we just mentioned all but assures we're probably looking at another 75 basis point move when the Federal Reserve meets here in a couple weeks. So let's go where I've been talking about with clients. Yes, capital markets, equities, domestic, international, basically off 20, rounding one way or the other. But I think the hidden story to most portfolios and why clients are looking at second quarter statements saying, wow, I'm off that much. To me, it's the bond market. It's actually not the stocks, right? It's core bonds off 10 in 6 months.
Yeah, I think that it's a great point, and I really believe that that's the case, because investors have seen stock markets draw down. COVID, while we have all tried to put that behind us, we saw equity markets draw down 25, 30%. Over the course of 3 weeks. I think it was the fastest entry into a bear market ever. I think 20 trading days. We went from all-time high to bear market. You can go back to the fourth quarter of 2018, where the Fed started to raise interest rates. That caused equity markets to go down, get into a bear market. And before that, you had the energy going from $100 to $20 a barrel in 2015 and 2016. And that is just over the last 5, 6, 7 years. While investors are not really conditioned to see equity markets go down, they have seen them. What they are not, and they are not manifestly ready for, was I think it was not only the absolute drawdown in bonds, but just how quickly it happened. And you talked about the doubling of interest rates, and for those, for those of our, clients, friends of the firm, and other folks that are watching, when we talk about interest rate sensitivity, let's just take a 10-year Treasury bond, and let's just say that has an effective duration of 8.5 years. So when we talk about duration, it's really the sensitivity of interest rates. So if interest rates go up by 1% or 100 basis points, we would expect that on a price return basis to be down 8.5%. We doubled that rate, so you're looking at these long-term ballast of the portfolio securities are now drawing down double digits. Yep. And that was the dirty little secret of why the 60-40 portfolio works so well. Equities more or less give you 9%, and we're going to talk about an analogy in here, a little bit of about kind of how that kind of plays out in the stock market. But the S&P 500 more or less gives you 9% on an annualized basis over the last 60, 70 years. Now, it's never 9 in any given year.
It's not a smooth 9.
It's not a smooth 9.
Over a 3 to 5 year period.
But it kind of, stocks give you what they give you. The bond market, when you have interest rates that peaked out in 1981, exactly when inflation hit its peak, you go from 16% interest rates down to as low as 0.32%, less than a third of 1 basis point or 1%. And during COVID, well, duration works the same way on the way down. So just like 100 basis point crank on the way up sends prices down like a seesaw, 8.5%, you get a 100 basis point cut on that same 10-year Treasury, you'd expect the price to go up 8.5%. And what happened over the last 40 years is that investors had a dual tailwind of declining interest rates and declining inflation. And as good as that was for equities, to your point, it was even better for bonds.
Right. Now, the silver lining that I've been talking about with clients is, look, yes, we've had a 10% drawdown in bonds in 6 months. Something that I'm getting the question, hey, why didn't you see the interest rates moving as fast as they have? Why haven't you seen inflation coming? I'll be honest, we've been talking about rising interest rates since 2012, and they haven't moved. It took, as you would like to say, a 1 in 100 year pandemic, and all of a sudden we've got the inflation inferno roaring at this point.
Yeah, and I think that there's some policy prescriptions by the Fed and other global central banks. I think we thought that they were behind the curve. I believe we spoke about that over a couple of different quarters. I don't think anybody here believed that inflation was going to be magically get back down to back to trend to 2%, and we quite frankly started to prepare client portfolios for that by moving into real assets, and it wasn't perfect by any means, but you can't. The investment saying was they couldn't fight the Fed, right? And to your point, the Fed wasn't going to raise 75 basis points until 2 days before their meeting last month when they raised 75 basis points. It was completely off the table.
The highest raise since 1994.
It was completely off the table until it was on the table. I mean, and we can't be mind readers, and there's a certain part of our portfolios that are always going to have exposure to high quality bonds, because at the end of the day, being down 10, while that's not great, and we're not saying that it's great, it's still a lot better than being down 25%. And what is what you get in the equity market. If you're going to hold a 100% equity portfolio, if you took that into this market, yeah, you had outstanding gains over the last 10 to 15 years, but you'd be white knuckling it, holding that wheel really tight, hoping for the reversal, because you've got no recourse. You have nothing to rebalance into. You just have to hold that portfolio and pray that the market turns around.
Well, maybe the final comment on interest rates, bonds, is the silver lining here is the expected return of bonds going forward has come up substantially, let alone if we see another 75-point raise here in the next couple of weeks.
Dramatically better outlook going forward for fixed income investors.
We have to live through this 6 months, and look, I'm not saying that bonds have hit the bottom by any means, but going forward, the expectation is when it was at 1.5, right? The yield on the 10-year at the beginning of the year, it's at 3 now. That's more or less a proxy for your outlook for bonds has doubled in 6 months. You
Yeah,
have to live through this period to get to that better outlook going forward.
There's no free lunch, and
Right.
you're going to have to get to a point where you're earning a reasonable yield at a reasonable rate of return in fixed income. This was the logical conclusion. At some point, it was going to have to go up.
Right.
Yeah.
All right, so I think we've addressed bonds. The other word that you use in the quarterly letter is perspective, right? You talk about your mother in the letter, and you know, if you'd like to elaborate on that, but I do think that is a very good word right now for clients, having a longer term perspective.
Yeah, I think so. I went up over 4th of July weekend to a small little town in Northeast Ohio called Conneaut, Ohio. My wife's family has a small little cottage, and the way I describe it is that it's like a 1,600 square foot structure that's longer than it is wide, and it's just it's a structure of bedrooms, and that's it. And it forces you to be outside, and the cell service isn't very good. And it also happens to be right about 50 minutes due east of where I grew up and where my mom was buried. And so on the 4th of July, I went to go see my mom's grave, and I was having trouble writing this letter. I was really trying to strike the right tone of acknowledging all the things that were going on in the market, and it just seemed like a lot. And so I went to the Walmart on Route 20, and I got some mulch, I got some flowers, and I went to go spend some time with my mom. And I was just thinking about, as I was kind of cleaning the gravestone and kind of laying down the mulch, and I was like, man, it's like Valentine's Day 2004, that's like 18 years. And then I was like, started thinking about it a little bit more, and I started to kind of rattle off, kind of going backwards, the returns of the equity market. Kind of like, man, like what did she miss? And it kind of gave me this, the more I kept saying the numbers out loud, or just from recollection, it was like those were some really good years. And so I kind of finished kind of taking care of her gravestone, and then I read her an article in the LA Times about my twin brother Brandon, kind of fulfilling one of her goals to go to Wimbledon, the tennis championships. And on the drive back, I was like, my mom's been gone 18 years, and she's missed a lot. She's missed, me graduating college. She's missed my brother and I getting married, us having, kids. And on the market side of things, it was like there was just a lot of things that happened in those 18 years. And when I zoomed out, it was like, well, man, perspective. Like, we've had a really good run since the day she passed away on Valentine's Day in 2004. And I went back into our portfolio software and I ran the numbers. So from February 16th, 2004 through June 30th, the S&P 500 annualized 8.9%. And on a cumulative basis, it returned 377%, just like a staggering amount. You almost quadrupled your money.
Right.
It doesn't feel like you quadrupled your money in this market, and that's kind of how markets work, right? The losses always feel worse than the gains, and I just...
there's academic studies that validate that too. That's not just theoretical. That's been proven out.
It's just like you're in it, and you're just thinking about the slog, and I was kind of, it just kind of hit me like, in this market, to kind of get you through, it's perspective, because bad times and tough markets don't last, and it never feels like they're ever going to end in the moment, and that tends to be when you start to see things turn. And so I thought it was a really interesting way to kind of crystallize for me the perspective that I am approaching client portfolios as the chief investment officer here. And then when I sit down and have dialogue with our advisors, trying to strike the right balance between acknowledging the pain that clients are going through, the very real pain that clients are experiencing in their portfolios, and trying to give them the kind of healthy dose of perspective that my mom gave me on Monday, July 4th. And so it's always good to go see my mom. and I was really excited because she, once again, as only a sixth grade English teacher could do, really helped me write this letter. And because she's not here, I can use things like semicolons and write long-winded sentences that she would never let me get away with. Please read the footnotes. She would never let me do that either.
Well, if you're going to go to the footnotes, I feel like ketchup is missing from the hot dogs, but at the risk of this video...
It's not an acceptable condiment. It's not an acceptable condiment on a hot dog. It's just not acceptable.
Let's go to this last point, and for the clients that I'm fortunate enough to work with, a lot of you have heard me say this recently. We are right now, right through early part of July, the S&P 500 is off 17%. Through 6:30, you were off 20, so you were in that theoretical bear market territory, right? From previous videos, most recent high off 20. The thing about bear markets, they are a phenomenal time if you have a long-term perspective to lean into sell-offs. I'm not saying that you go all in at once, but the problem with bear markets is you won't know it's a great time to buy till 2 to 3, 4 years into the future.
Yeah.
But typically speaking, it is a very good time to make money. You just won't know it for 2 to 3 years out.
And it's really that level when you feel the least comfortable buying. Those tend to be the best times.
How do I know I'm going to make money today?
Well,
you know what? You don't.
And in most cases, it'll probably go down before it goes back up. One of the things that we're going to talk about in our capital market slide deck that we're going to discuss is that the average bull market lasts 51 months. The average bear market lasts 20 months. Bull markets always last longer than bear markets, and if you take out some of the bear markets that happened during the Great Depression, that number goes down.
Right.
Again, it never feels good when you're in the middle of it, but taking a deep breath, taking a step back, and acknowledging at least in Schneider Downs portfolios, you're never going to own 100% of the best performing asset, but you're never going to own 100% of the worst performing asset either. So you're going to have this mix, and we talk about diversification and different levers to pull on. To your point, if you don't feel comfortable putting money to work, you can hold the portfolio and it'll heal itself over time. If you feel like you can put more money incrementally into the market, well, if you liked your portfolio on January 1st of this year, you should probably like it a little bit more now because it's more reasonably valued.
Well, in the letter, you highlighted the technology names that took the drawdowns. The Netflix up 70. You highlight Apple, off
best performing, best performer. Yeah.
So maybe in closing here, right as we sit here middle of July, look, in my opinion, we may already be in the midst of a technical recession, right? 2 quarters of negative GDP growth. I know that we like to define it here domestically as it's not exactly that, but that's the finance 101 definition of a recession, right? It's 2 negative quarters of GDP print. Recession is a concern. Recession, you're about to go through second quarter earnings. I think that's probably going to be the most searched Google term in all these management commentary calls. How many times is recession mentioned? So maybe giving you the final say, give our audience, okay, recession, uncertainty, everything we've talked about, perspective, maybe some closing thoughts.
Yeah, I think an unelected bureaucrat in the Department of Labor is going to be crunching numbers and talking about whether we are or not in a recession. I think that definition doesn't matter to someone who's trying to figure out, do I buy bread for my kids or do I put gas in my car?
Right.
So I think whether we're in or not in a recession, what we can say definitively is we're in a slower growth environment. Maybe it's negative, and where inflation is far too high and has been far too sticky. And there are a lot of different things that have gone into that. What I would say is that you've got a Fed that is committed almost to the point of making a policy error that they're going to get inflation under control. And if they do put the economy into a recession, it's going to be collateral damage.
Inflation run hot and get sticky.
Because it hurts the most vulnerable among us. I mean, Dave, you and I, if gas goes to $5.50 a gallon, it's not great. We won't like paying it, but we can pay it.
Right.
There are people in Columbus and Pittsburgh and wherever all the other cities that our clients live in that's a very real decision. That's a hard thing to do, is to figure out what do you want to do with the $10 you have in your checking account. And that's why inflation, quite frankly, needs to get taken care of. Longer term, when you look at valuations I mean, the small cap valuations and medium-sized company valuations domestically, they're at the lowest. Historically speaking, they're at the lows. The last time we saw them this cheap were in the throes of the great financial crisis when we kind of thought the banking system was going to go under.
And again, if you take a 3, 5, 10-year horizon and look back, that was a phenomenal time to be leaning in.
There was a phenomenal time to be leaning into assets. And what I would say is that I think we as advisors, and I know this when we stress test our portfolios and we do financial plans, that's the reason why if markets are giving us 8, 9, 10%, we're never running your financial plan, growing your portfolio at 8, 9, 10%. We're running it more conservatively because what we want to do is make sure that your portfolio can sustain some body blows and your goals and objectives are still intact.
Yep.
And so what I would say is, if you're feeling to the clients, if you are feeling as if your goals and objectives are impaired, or you can't hold the amount of risk, you thought that you were a 70% stock, 30% bond investor, and maybe that's not the right mix for you, now is the time to reevaluate that, to discuss with your financial advisor, because you might be feeling something because you open up your Schwab account and the value goes down, and we can show you, yeah, the value of your account is down, but your financial plan is still intact. And I think that more than anything else is something that you really need to lean on in this time. And again, I'll go back to this idea of perspective. I was fortunate to go visit my mom, and I got some, and I think that it gave me a lot of clarity coming into writing this commentary and then coming in and talking to clients. And I think taking a longer term perspective is the one thing that's really going to help us, get out of, the troubling times we find ourselves in.
With that, I think we'll call it a wrap. Thank you for the thoughts, and obviously to the clients, please reach out to us. We would welcome a chance to have a conversation with you.
Thank you very much. Looking forward to doing it again next quarter.